A while back when we were looking at topics to cover for this session, we thought that to get people's attention, I think we would all agree you got to hit them in the pocketbook. And if you can hit them in the pocketbook, you're usually pretty safe that somebody's going to stand up and take notice. And so to put this group together, we feel very honored and privileged. We have the Honorable Mike Twitty. Mike is the Pinellas County Property Appraiser. I might add that he also plays a mean guitar in his band. And one thing I wanted to add is Mike is currently the chair of the Florida Flood Impact Committee with the Property Appraisers Association of Florida. So I think that's very germane to our topic today. Mike? Next up we have Jake Holehouse. Jake has been in the insurance business, I think, all his life, or at least pretty much there. Collectively, I might add that all of these participants this morning have over 30 years of experience in their field. So they come to us with some firsthand knowledge about the topics upon which they're going to present to us. Jake is a chartered property casualty underwriter, a title which he has earned. And last but not least is Denise Drew. And Denise is also a lady of distinction. She holds many certificates and licenses. And I wanted to add she is currently the chapter president of the Tampa Bay Mortgage Bankers Association and a member of the Florida Association of Mortgage Professionals. So we're trying to look at this situation from three perspectives. Number one, your property values. Number two, can you get a mortgage? And number three, can you get insurance to get that mortgage? So we're going to start this off with Mike Twitty and talk about property values. Mike?
Well, thanks. Thank you, Bob. Glad to be here today with you. You know, we've got some things. Obviously, sea level rise is a longer-term concern. One of the things that really concerns myself, and I think many of us on this panel, that would be shorter term, would be flood insurance affordability, because that can obviously impact our values much sooner than sea level rise right now. With the NFIP influx, I'm not going to get into that too much. I'm going to let Jake, I don't want to steal his thunder on all of that. So, so that's one of the things we're really looking at closely within our office. We are watching, you know, many of you probably know that preliminary maps have been issued for Pinellas County. They have not been adopted yet, but we're paying attention to the areas of concern where the base flood elevations we know are rising that could impact people's property values. So we're watching active listing activity in those market areas and tracking sales so that we can be proactive and see that in advance of it starting to, you know, truly affect people, so that we can try and be proactive on how we address values from the assessment world. Obviously, you know, there's two different things going on there. You obviously have the typical market, and we try and track the market in what we do, but our values at the end of the day are for, you know, trying to arrive at for tax assessment purposes. So it's a little different, but obviously it's all driven by the market in general, and we always lag. So always keep in mind our office is always as of January 1, and we're typically looking at sales in the previous year. So when we set values for 2019, January 1 is our effective date. So for 2019, we're really leaning on 2018 sales. We're really not looking at 19 sales. So when people think we're behind the market or our values are low or things like that, it's usually because we are. We're erring to the property owner's benefit in that we're in arrears in that regard. Just to give you some perspective, though, how many properties we have within the special flood hazard area, which would be, you know, all your A and V zones, essentially. It's about 68,000 properties. It's about $25 billion of market value and about $17 billion of taxable value. When we went through this last time, or a couple of years ago, and the House ended up passing a bill that would have capped insurance rates, premiums, annual premiums, at $10,000 for a lot of our homeowners. We went back in and we dug in, because obviously the perspective from DC with a lot of the congressmen that aren't from Florida is that everybody lives in a mansion on the water and we don't want to subsidize them. So obviously we know that's not the case if you live here. 72% of our single family homes only have a median value of about $206,000, and those are non-waterfront properties. So 72% of the properties in those A and V zones are non-waterfront. So whether it's increases in flood premiums or sea level rise, my opinion is that those interior properties are going to be affected the most and the soonest. Because if you want to be on the water, it's kind of the price you have to pay. But if you're on a non-waterfront parcel, you don't have, you can go to higher ground and buy the same property and not carry that premium. So those are the ones we're watching, with a real close eye, because those are the ones I'm most concerned about. Value impacts. The market will ultimately shake that out. Like I said, we're trying to track that. There are various methods of how we can actually estimate that, but we haven't seen, nothing in the market is exhibited that there are impacts at this point from what we've been looking at. I know there have been some studies down in the Miami-Dade area where some believe there are some impacts, but some of the methodology could be questioned as well, how they arrived at that. So we're going to dig into some of that as part of the Florida Flood Impact Committee with the other coastal property appraisers around the state. I'm chairing that committee, so we're all working together to kind of come up with a good common methodology that we can apply around the state. Mitigation efforts, obviously anything we can do to continue to make our infrastructure more resilient in those coastal areas, prevent the things like the picture Maya had of the storm sewers backing up, putting flapper valves on, raising roads where we can, any vaulting that we can do, any of those types of things to minimize those blue sky flood days is of great benefit, and will give us that much more longevity and obviously help to buoy the tax base for the longest period of time. Long term, it's hard to say what that's going to look like. We get 30, 40 years down the road, obviously you could start to move into a retreat phase where a lot of people could start to back away from the barrier islands. But I'll let these two talk more about that and what that might look like from a insurance and mortgage side. I'm always cautious about sounding alarm bells too much, because I don't. When you're writing 30-year paper, you don't want to scare off the insurance companies and the lenders in advance of the water rising. Hasn't risen an inch yet, but we're scaring the lenders and the underwriters so that they don't want to write paper in our market areas. So with that, I'll pass it back to Bob.
Okay, thanks, Mike. Next up, let's hear about the insurance industry. Where that's been and where it's going. Jake?
Yeah. Good morning. My name is Jake Holehouse, and I'm the president of HH Insurance in St. Petersburg. And also I am the FEMA policyholder advocate for Pinellas County, the city of St. Petersburg, and the city of St. Pete Beach. And so really, I'll kind of touch on the history of the National Flood Insurance Program, where it's been, where it is today, and kind of where we see flood insurance going and how it affects with sea level rise. So there's a lot of confusion in terms of the flood insurance program, and probably about 95% of flood insurance is written in what's called the National Flood Insurance Program. The National Flood Insurance Program was started in 1968, and the reason it was started is because private markets did not want to write flood risk at that time because when flooding happens, it affects all homes. You think about fire insurance, if you insure 100 homes in a neighborhood, only one of those homes burns down. You think about hurricane risk, maybe 10 of those 100 homes are affected. But with flood risk, all 100 can be affected. And so you had a lot of insurance companies taking flood out of policies in the 1960s, which then started the National Flood Insurance Program in 1968. In Pinellas County, what we look at is we've got what we call pre-firm and post-firm properties. And what that means is that FEMA comes in and draws our flood insurance maps and says how high your house should be to protect you from flooding. So in Pinellas, they started doing these map drawings in 1971, and they really took effect in January 1st, 1975. If you pulled a building permit, you had to build up to a certain flood standard. And so prior to 1975, you've got what's called a pre-firm property. Post-1975, you've got what's called a post-firm property. And basically, that's where you typically see those newer homes that are elevated, and that's because they're built to a flood map. But you've got those older 1960s type homes that are that traditional slab-on-grade home. So, you basically got from 1975 to about 2005, where the flood insurance program did really well. It basically, for every dollar coming in, it paid about $1 out in claims. And then you had this massive event called Hurricane Katrina hit. And that put the program in a massive amount of debt. And that's where flood insurance really started being talked about. And then a couple years later, you had this event called Superstorm Sandy, and that added about another $10 billion of debt to this program. So now you've got $25 billion of debt. So then from there in 2012, we saw what we called the Biggert Waters Act. And that was really the first, I guess I would call, alarm of flood insurance rates increasing for people. And it was really due to the amount of claims coming in were really starting to get a lot higher than the amount of premium that was being collected. And so when Biggert Waters happened, if you kind of rewind the clock about 6 years, you heard about flood insurance rates are going from $2,000 to $20,000 for a lot of homeowners. And that was part of that Biggert Waters Act. And so since Biggert Waters, which was 2012, 2013, we've really seen a lot of uncertainty within the flood insurance program. The good news of Biggert Waters is that it extended the flood program for 5 years. So that extension happened in 2012. But then since 2017, we really haven't had any long-term sustainability to the flood insurance program. Congress continues to do like 90 and 120-day renewals as they figure out what to do with this program that continues to lose money. Now, my personal opinion on that is that when you have a program that continues to lose money, that typically means rates are going to continue to go up. And so where are we now in terms of flood insurance is you've got those pre-firm homes. Those are your slab on grade below current base flood elevations. And they are continuing to see a steady increase in premium rates. So they are seeing premium rates increase on average for a primary home at about 15 to 20% per year. And then you've got the secondary, seasonal, and commercial properties that are pre-firm below elevation that are increasing between 25 and 30% per year. And they're really seeing what we call full risk rate escalation happen very quickly. And then you've got these private flood carriers that have come in and started writing business, but you're seeing most of them not really want to take on a lot of the coastal risk on the barrier islands. They say, hey, we'll write a policy in Pinellas Park, let's say, for private flood, but if we're going to write it in Treasure Island, we want to get substantial premium rates, and that's because the risk is so much higher. So over really, I would call it the past 6 years, we have seen kind of a shift in terms of flood insurance rates for a lot of these barrier island type properties. But you can look at Mike's numbers, and it really hasn't slowed down the real estate transactions happening on barrier islands, even though the flood rates do continue to increase. The biggest challenge with the National Flood Insurance Program as it sits today is that it doesn't really take into effect sea level rise. Flood insurance is rated on historical data. And so when we look at flood insurance, a house that is in an A zone, assuming all risk characteristics are the same, a house in an A zone direct on the Gulf of Mexico and Treasure Island pays the same as a house in an A zone in Polk County. But yet we can pretty much determine that there's two different types of risk with things like storm surge and anything along those lines. And the other challenge is you've got the flood maps that are drawn by FEMA, and in the flood maps, it's also rated on historical claims data. So now you've got these preliminary flood maps coming out, and for a lot of areas that we would say are probably most affected by sea level rise are actually getting favorable results on these flood maps. You see areas in like Tierra Verde, Treasure Island, St. Pete Beach areas where the FEMA is saying that you actually don't have to build as high. So they're dropping what we call base flood elevation, which is how high you have to build the home, by 2 and 3 feet in some of these areas. And so, because again, it's rated based on historical flood data, and it doesn't take into effect the future outlook on things. Now, we are starting to see that shift a little bit. So what FEMA is doing right now in terms of the flood insurance program is they are coming out with what they call flood rating 2.0. And it's really the biggest shift that's ever been talked about within the flood program. We don't have all of the details on it right now. It's not really even it's not on the table in the immediate for Florida, but we're starting to see it in areas such as like South Carolina, where they've been affected by flood really the past like 3 years. And what Flood Risk 2.0 is it's going to start taking into effect storm surge effects into flood rates. And the limited information that we have on that right now is that it can be pretty much a plus 50% or a minus 50% on your flood insurance rates. I think as that starts to take effect, that's when you'll maybe start to see the shift happen a little bit more with flood rates, because then you have a house in Treasure Island that right now pays $3,000 a year for flood insurance. At a plus 50, they're going to pay $4,500 a year for flood insurance. Might not affect that waterfront house as much, but that guy that's sitting across the street from the water, now that starts to become a severe carrying cost to living there. But then you have the house in Pinellas Park that's in a flood zone, and if they take a minus 50 based on not having the storm surge risk, they go from $3,000 to $1,500. And so it's my opinion that over time, as this flood risk 2.0 happens, and you start to see flood rates happen where they start to come in lower on these on the interior homes and really start to surcharge on the barrier islands, that would be the point to where you'll probably start seeing effect on that. And a lot of the flood risk 2.0 does take into effect the sea level rise. But again, it's rated based on where it is today, not based on future projections, but it will start to see the storm surge models for the first time really incorporated into the National Flood Insurance Program. The private flood markets already incorporate storm surge, and so you see that they don't play as much on the barrier islands, but they really like to write interior type properties. And so now you're gonna have FEMA kind of take that same shift, and that, in my opinion, is what could start to shift the market somewhat away from some of these very high risk interior type homes. And with that, I'll turn it back over to Bob.
Thanks, Jake. And finally, if you can't get a mortgage, you can't get a house. So Denise Drew is going to fill us in on the latest in the mortgage market.
Thank you. My name is Denise Drews. I'm a mortgage banker. I work for Paramount Residential Mortgage Group. We are a nationwide lender, and our top markets are California, Texas, and Florida. So, as a company, we see the impacts of climate change with the wildfires and the flooding and rising sea levels. I have lived and worked in flood-prone areas my entire life. I was born on the North Shore of Lake Superior in Minnesota, lived on the banks of the Mississippi, and I've been in Pinellas County for 30 years. So always been in a flood-prone area. It's always been first and foremost, in my mind. And the question was asked of me, what is the mortgage industry's position on rising sea levels? And the short answer is, we don't have one. The mortgage industry is completely unprepared to deal with rising sea levels. And there's a lot of reasons for it. The big reason is that we're federally regulated. And to make any kind of a change takes years and years of debate and back and forth and bipartisan politics, and things don't happen quickly. And with regards to how this impacts mortgages, if a person is willing to buy a property and they qualify for that mortgage, and the property appraises for the amount that they are willing to pay for that property, even if we know in less than 30 years that house may be underwater, or we have reason to believe it's going to be underwater, even if we have reason to believe the cost of that flood insurance could make continued ownership prohibitive, at the end of the day, we have to make the mortgage, because if we don't, it's called redlining. We can't refuse to lend anywhere because we fear that property values will drop, whether it's due to rising sea levels or crime-prone areas or ethnic mixes of neighborhoods. We can't refuse to lend. It's a federal law. It's called redlining. We have to do it. Now, that being said, what we are seeing is retraction of values. And there's talk of creating a line item adjustment on appraisals for RSL, which is the rising sea level adjustment. And currently, we're thinking it's about 7%. Again, this is talk, and it could take years to be implemented. There's talk of not making 30-year mortgages in properties that we have reason to believe will be completely underwater or partially underwater, before the term of the mortgage is over. So we are looking at having mortgages that are literally and figuratively underwater. Again, it's talk. It takes so much time to make any significant changes. You all know about the mortgage meltdown that we had in 2008 and what happened to our values and the implementation of the SAFE Act. And my personal opinion is that, reform was needed in our industry, but that pendulum went way too far and made that restrictive. And right now, our energy is focused on making the mortgage industry more accessible to people than it was prior to the implementation of the SAFE Act. And we're just not focusing on what we should be focusing on, which is rising sea levels and retracting values. I am the president of the MBA for this area, and I just spent a few days in Tallahassee with our lobbyists at the Capitol. And I mean, our big thing right now is to legalize e-notary so that we can close mortgages online versus face-to-face, because we want to keep up with the market, which is millennials who want to do everything on their phone, including not talk to their parents. So we're not prepared. And I don't know what it's going to take to be prepared, so we rely heavily on the insurance industry to do what needs to be done to make it change. I mean, there's some crazy things that we have to do in the mortgage industry because it's federal law, and one of them is if you're buying a McMansion on the beach and you're paying $2, $3, $4, $5 million for that McMansion, the most coverage you can get under the National Flood Insurance Program is $250,000, which is a drop in the bucket. We know it's a drop in the bucket, but we have to accept it as proof of flood insurance. So our industry, again, we don't have a position because we're not prepared. In theory, we know that there's problems, but it's gonna be a while. So as far as mortgages go, what's going to affect the ability to get a mortgage is going to be the cost of the flood insurance. The higher the flood insurance, the more people there will be that cannot afford it, cannot qualify for the mortgage. But today and going forward, if you have the income to support the debt, and that debt does include flood insurance, and if you have the credit to meet our credit standards for mortgages, and you have the funds to make your down payment, because thankfully we're not doing 100% mortgages anymore, because that was a big mistake back in the early 2000s. But at the end of the day, if you meet that criteria, and it's a federal law, ATR, ability to repay, if you meet that criteria, we must approve the mortgage. Thank you for your time.
Wow. All I can say to that is wow. Very interesting. Let me throw a question back at the panel. Is there any discussion or have you ever heard anything about climate insurance? Not flood insurance, but climate insurance. And the reason I throw that at you is because obviously climate change is bringing about a lot of various ramifications. Are those entering the marketplace anyplace?
You know, most things are really already covered in a homeowner's policy. And so that's where, you know, a lot of times you hear about maybe like a national catastrophic fund or something like that for areas affected by tornadoes or for you know, things beyond just flood. And it's always kind of a head scratcher to the insurance industry because tornado wind is covered in a homeowner's policy. So what happens a lot of times is when you talk about like climate or, you know, increased catastrophic activity, it's that you would be shocked at how many people just say, I don't want to carry insurance because I'm going to get a bailout in the event that something happens. And so it's really most people rely on that, at least from what we see. I mean, it's even, you know, we have a lot of homes in flood zones that don't carry flood insurance because they make the assumption that if a big flood happens, they're going to get a government bailout. And so for a lot of people that don't have a mortgage, they just elect that they don't want to carry it. Now you have some that say, I don't want to carry it. I understand the risk. I'm comfortable with that. And you have other ones that say, I don't want to carry it just purely because I just believe that I'm going to have a government bailout. So that somewhat is already within any type of standardized insurance product for that increased cat activity.
Okay, thank you. Let me throw a question at Mike. What data set, and I'll phrase it that way, would you be willing to accept from a property owner who said, my property value is on the decline, is going to decrease because I'm looking at these projections of sea level rise and I see that my property is going to be underwater here in 10 years. Can I claim a decrease in value?
Sure, if you can prove it.
Well, I'll take the data that's been submitted.
Right. I mean, if we start to see market evidence of those trends occurring in different neighborhoods, you know, if we start seeing, you know, more days with roads underwater in certain areas, we know it's going to start to have an impact, and we'll be tracking those areas closely. So actually quantifying what that amount's going to be is going to be tricky, but as the data starts to unfold, certainly we'll be all ears and we'll be watching it ourselves. So markets are far from imperfect, or far from perfect. They are very imperfect. So we have to let that data sift out. I think you're going to see it in very focused areas first. You know, some of the areas that have traditionally already had some flooding issues around Pinellas County. But again, the resiliency efforts that go in, you know, replacing lateral lines, doing these things even to prevent these backups into homes via sewer systems and things like that, closing those systems and making those more resilient, because you can have that intrusion into homes before the water gets near your doorstep if you're not careful. So those are other, you know, projects we really have to be working on over the next, you know, this next decade. It's really important to get a lot of that infrastructure solidified.
Has that undertaking started?
In some areas, there's a lot of talk about it. There's even a bill in Tallahassee this year about replacement of lateral lines and testing of those, and actually creating a database so that wherever these tests have occurred, you know if it's a line that has passed or failed those tests. I know in Gulfport, they actually created a fund for certain homes where they were, I think, giving them a grant up to 50% of the cost to replace their lateral lines. That fund was actually created because Gulfport was fined by the government, and then instead of paying the fine, they allowed them to put it into a fund to replace lateral lines. So, which I think was a good idea. So I think some more programs like that to help incentivize our homeowners to go ahead and take the initiative to get that stuff done. We know St. Pete's been in the news a lot. They probably the area that has the biggest issue with their lateral lines. But I know it's not St. Pete alone. It's around the county.
Okay. Denise, you mentioned that It's going to be a long time as the wheel turns. Any forecast?
It's really hard to predict. I think that, yes, eventually we're going to see some changes that have to be made to the mortgage industry, but it's going to have to be done at the federal level, and that's going to take a lot of time. I mean, the closest thing that we can come to right now is just the line item adjustment on appraisal, reducing the value by 7% of a home in a flood zone versus a home that's not in a flood zone. And a good example is I closed on a transaction yesterday, and it was in St. Pete, and it was in an area that's within a mile of homes that are in flood zones. Now, the home I closed on is not in a flood zone, and it appraised. And when we underwrite mortgages, in addition to getting the physical appraisal from the appraiser, we run what's called automated valuation modules. And the AVM that the underwriter ran pulled up properties within a mile of that property that were similar square footage, similar amenities, sold for less money. And you know, we have to go back to the appraiser and go, okay, why did you not use this one, this one, this one, and this one as a comparable sale for coming up with a value for our subject property? And the appraiser's answer was flood zone, flood zone, flood zone, flood zone. So similar properties within a mile of each other, if they happen to be in a flood zone, they're worth less money and they sell for less money. So that's our only impact right now on values, is what is a buyer willing to pay. But again, Freddie Mac and Fannie Mae, their economists are warning us, you know, as an industry, you need to pay attention, you need to do something. But it has to happen at the federal level, otherwise we're breaking laws. So I don't know. We're still trying to fix all the mistakes they made with the SAFE Act and Dodd-Frank. And that's taking up a lot of our time right now, is fixing that and making mortgages more accessible.
Okay, I'll tell you what let's do. Yes, I'm going to go there right now. Let's turn it over to the audience and see how many questions we have here. Do we have mics? Okay. This gentleman right here, Claire, was the first hand up.
This conversation, to use Maya's presentation, some visual imagery, reminds me of a giant Jenga game where everything looks good, you pull pieces out, you pull pieces out, and eventually we all know what happens with Jenga. You pull a certain piece out and the whole thing collapses. And the other image, since we're in Dali territory, is a circular firing squad. You say it depends on flood insurance. You say the flood insurance is going to change. Is this smelling like a cliff that will eventually come to, or will it be a gradual, controlled shift in values? I've heard stories in both directions.
Yeah, you know, I'll answer from the flood insurance standpoint. You know, you're seeing rates gradually start to rise. So let's just call it a gradual rise of about 15% a year right now for those pre-firm properties, meaning the slab on grade. The elevated home risks, you know, we're really not seeing a material effect in terms of flood insurance rates at this point. That could change with flood risk 2.0, but we don't know what that looks like yet. And so I think the slab on grade type homes become less and less economically feasible over time because those rates continue to go up. You know, when you're looking at $4,000 and $5,000 for flood insurance in a non-waterfront home, that kind of changes the value factor a little bit. Compared to that elevated home that's at like $400 and $500, you know, it starts to really shift. But the elevated homes can be affected by, you know, sea level rise as well, and you're not really seeing that take any type of account with the way flood insurance is rated today by public or private markets. And so at this point, I would say it's kind of too early to tell from a flood insurance standpoint where we're headed in that direction.
And on the mortgage side, you know, it's kind of like the field of dreams thing. If you build it, they'll come. On mortgages, if you can afford it, we'll lend. So we're dependent definitely on the cost of the flood insurance. As flood insurance goes up, affordability goes down for a lot of people. So we, are two industries that have to work hand in hand to make it happen. And happily, we're not contentious with each other. We want to work together, but again, it's federal and it's going to take time.
Bill?
I'll talk a little bit about the bailout assumption with how real is that, and how do we get some clarity in the United States about when that won't occur and when that will occur as far as influencing where people choose to live?
Yeah, so the bailout assumption we see from a flood insurance standpoint is that people just assume that if they have a flood loss and they don't have insurance, that the federal government's going to come throw a lot of money at it and they'll be able to qualify there. The challenge of that is it's not necessarily a true assumption at all. The federal government does not just hand out money to homeowners. It's a loan, and it's about a 8% interest rate, and it's a very, very steep qualification to be able to do it. And so it's definitely, they heard it on the news 15 years ago that somebody got a bailout, or it's something like a Katrina or a Sandy where, some homeowners did get some subsidy from the federal government. They assume that means all homeowners get a subsidy from the federal government. And so then a lot of people don't necessarily put a lot of research into it, and they just make that assumption and choose not to carry certain lines of insurance. But from our angle and from what we see, it's not a very true statement, but convincing that of somebody that saw it on the news 10 years ago is a uphill battle at times.
Thank you. Over here in the back. Oh, here we go.
Thank you. This working? Okay.
Yep.
Along the same lines, whether it's a bailout or assistance or the cleanup from the storm, and then to Mike's issue with improving the laterals, what I'm looking at here is that this is a general cost or a cost to the general public. So essentially, society is paying for improvements to individuals or a neighborhood. So to me, it looks in general as everybody pays for a subset. So it's a transfer of funds. And when we look at the sea level rise issue long term, it's going to be the same thing. That folks who are living at the coast or in certain properties in the flood-prone areas, or what we're doing at the coastlines, trying to prevent today's high water from impacting those areas. What's going on in Southeast Florida with improvements of the roadways and all these things. But what's happening, as I see it, is that there are special efforts being made to improve certain living areas to the benefit of those who choose to live there, and everybody's paying, whether it's a tax base or general funds, or, for example, the utility bills are paying for the improvements in certain limited areas. So is this what you're seeing for long term, whether it's 10, 20, 30 years? Is society in general going to continue to pay to the benefit of those who choose to live someplace which is going to be impacted first?
Well, the flood insurance side of that equation, we go into this risk rating 2.0 is essentially moving away from subsidies and trying to place the appropriate premiums on the appropriate properties. When you get into the lateral lines and reinforcing infrastructure close to our coastlines, yes, if those are coming from general funds, I mean, there could be special assessments that could, be hitting at the property level as well. The lateral lines, I see those are going to be mostly paid for by the property owner. Yeah. But when you also have you could make the argument that, well, getting more coastal resiliency also helps protect those properties that are more inland over time. So, there probably needs to be some sort of resiliency when we're on a peninsula, we're pretty vulnerable from every direction. So being smart about those investments, and when you go into subdivisions and they need, maybe they need to do some road work, and trying to align those projects to where, yes, we might have to put some extra dollars in, but do it in a smart way so that you're not going in after the fact when you're not working in that area and having to rip things up and make improvements. But I think the county itself is trying to get better with that with their enterprise asset management program. They have a lot of new employees and assets that they're really trying to move towards being more proactive in the economic life of all the assets related to infrastructure throughout the county, so they can track that better, actually before something breaks, know when it needs to be replaced, and align all these priorities in a more logical way. I don't think you'll ever completely get away from some form of the impression of subsidy to some property owners. I mean, we have it in all throughout government, whether it's affordable housing or infrastructure enhancements. I mean, PSTA, whatever you want to say, there's always going to be a certain function of government trying to spread those dollars around and help people out. So, and those people that are living in those areas, like we said, they're not all living in McMansions on the water. So you have a lot of people that are sitting there in homes that are worth around an average of $200,000, and all of a sudden their flood insurance spikes by $5,000 to $6,000 a year. It's going to turn them upside down. So,
Does that answer your question?
You did well.
Okay. Thank you. Let's go to the back in the orange.
So thank you so much for a great panel discussion. I'm actually a scientist, and I'm not one of the 40% of people in the U.S. who don't own a home, but you guys actually made it sound really engaging and interesting. So I just want to, first of all, thank you for explaining things that I haven't really understood. So one of the things I've been sitting here thinking about is how much our tax revenue is based on home ownership. And so I'm curious to hear whether there's any talk about whether we need to be looking at a new model of home and land ownership in the United States, particularly around the coastlines, and coupled with a new way of looking at tax revenue generation. So that's a big, big question. But the other thing that I feel extremely concerned about is displacement and increasing homelessness, right? So whether we're looking at a model in which we could have increasing numbers of people being homeless and the impact on our society for that. So those are two big questions. Feel free to bite them. If you can answer them, I'd be happy to hear your thoughts on them.
Anybody want to take that?
That's Mike.
how did I know that was going to land on me? As far as a new ownership model, I've not even thought through what that could look like. When you speak to home ownership and homelessness, I mean, we have plenty of room in Florida to move inland, not in Pinellas County, but I don't. In 40 years, I don't know. Pinellas actually was part of Hillsborough County originally, and was split off after the population got to a certain level and became its own freestanding county. But over the long haul, you could see it, get absorbed back into Hillsborough County or another adjacent county, in order to combat what impacts might be on our tax base. So I'm talking long term here, but you could see, obviously our 10 barrier island cities, those could go away, or those could collapse back into the county or another city, whatever's left, because you might have certain barrier islands that may stand longer than others because of their elevations and the efforts they've put into their infrastructure resiliency. So there's a lot of things that could happen. We do have right now, about 40 to 45% of our tax base is in the special flood hazard area in these residential properties. So it is a sizable amount. So we would certainly have to get creative if that tax base base begins to erode. We're not going to make it up by just trying to compress into the middle. That's not really going to get us there. So long term, we're going to have to be thinking about some different things. We may not be 24 municipalities anymore. You know, the consolidating departments, and, you know, there could be a migration back to unincorporated. Long term, that may be the best thing for the tax base in some regards. So
Okay.
I'll leave it there.
Let me go to this lady in the white here. Do you have a? Here's a microphone.
Hi there. My question is this to Mr. Twitty. I recently sold a home that I purchased in 2006, which was approximately sold for the same value that I purchased it for then. And I am wondering if you see values of homes trending toward that value base between 2006, 2008, which was the height of real estate.
Right. Right. So you bought pretty close to the peak.
Yes, absolutely. Yeah.
So, and now you sold it again, and so that
Right.
that confirms what we're seeing as far as in most areas we're back to that peak again. It varies by, you know, areas of the county, certainly, but we have returned back to that in a lot healthier way than we got there the first time around. I think she could attest to that.
Yes.
We got there, you know, very rapidly, and there was a lot of smoke, but we hadn't seen the fire break out back in the last crash. I mean, I was in the private sector at that time doing appraisal work, and the 3 years leading up to it, it was defying all market fundamentals. You know, I'd been through several cycles, but it made no sense. But we didn't know all these derivatives were going on, and, you know, all these things that were essentially propping up the mortgage market for let the musical chairs game go on, you know, about 3 years longer than it should have, and then the music stopped. So, but.
So you're seeing that at the assessor's office, that the values are trending toward the highest values?
Yes, yeah, we're back there at that peak again. Last year we had a taxable value increase countywide of 8%. I think it'll be a little lower this year. We have seen some areas start to kind of plateau off, but you still have markets in St. Pete and on the Barrier Islands where things are still ripping along. A lot of home buyers coming in from, you know, out of state and paying big numbers, and we're seeing a lot of cash transactions too.
Thank you.
Sure.
From a lender's standpoint, with regards to values, you know, we have seen our values increase in our area at a higher level than it does nationally. And right now, well, recently we felt like we had hit kind of a peak, and we're seeing values roll back just a little bit. But now that rates have dropped, and that increases the market for people that can afford these properties, we're seeing it go the other way. So we're seeing kind of an ebb and flow in values, and our predictions in the mortgage industry is that we're going to continue to see a slow and steady increase, not the big ones, because we've had very big increases in value over the last couple of years. But again, mortgage accessibility is still one of our biggest issues. There's a lot of people that should be able to get mortgages that can't, because they don't fit into that little bitty box that we call ability to repay. And yeah, that box was huge, you know, in the early 2000s. That box was kind of, if you can fog a mirror, you can get a mortgage. And, you know, happily we've, you know, gotten away from that, but we made it too narrow, too small, too difficult. So little by little, we're expanding credit accessibility as well.
Claire, this gentleman here, please.
Yes.
Excuse me.
Excuse me. I was going to, the gentleman behind.
Oh, sorry. I was interested in the question about the increase in homelessness, but also affordable housing. And I hear you sort of getting into that some more. And although I know there's a lot involved, I would love to hear your take on the increase in homelessness and the decrease in affordable housing.
With regards to affordable housing, that's a tough one. One of my closest friends is Brandy Gabbard. She's a City of St. Pete councilwoman, and that is her thing, is homelessness. And I work with a lot of the down payment assistance programs throughout the county, and affordable housing is a huge issue everywhere in our county, and there are a lot of measures being taken, but it's going to take a lot of help from the government. There's something called the Florida Hardest Hit Funds, and that provides $15,000 down payment assistance to people purchasing in counties that were considered hardest hit. And up until this year, Pinellas was one of them. We are not considered one anymore. So our down payment assistance avenues are a lot more limited than they used to be, and I think it's going to create a bigger impact on affordable housing.
Okay, let me go back to the original gentleman right in front of you, Claire. Okay, then we'll come over here.
I do see a house of cards if the floods come up and somebody has a $4 million house and it's now worth $250,000, and they say, why am I here? And so away goes their jobs and everything else, and suddenly the county loses most of its tax base. But that's a whole nother topic. I am wondering specifically if, I was surprised about the mortgage and the problems that are there. It's brand new news to me. Thank you very much. All this has been good stuff. What happens to the bond market? I'm thinking that, say, we have to build the causeway out to Clearwater Beach another 4 feet high to maintain accessibility during high flood levels for emergency vehicles and things, and maybe even Gulf Boulevard higher, like they did in Miami Beach. Would that be subject to the bond market, or would we not be able to get bonds to do that type of financing?
You want me to take that?
Go right ahead.
And I don't know if Kelly Levy touched on this yesterday. She may have talked about, I'm going to use one example, the Dunedin Causeway going out to Honeymoon Island. That bridge needs to be replaced. They're looking at a bond issue on that, I believe, and there have been different sea level rise models. So they're trying to figure out, well, how long are people actually going to be able to go out and utilize Honeymoon Island? So how high do we need to redesign this bridge? They want to try and make it where it's high enough they can get boats through it, but obviously that where you bring it down and how much you fill the roadway for the land portion of the causeway. So they have to make those types of decisions and figure out which forecast they're going to go with. I think those dollars will be available, and obviously they have to weigh out. We generate a lot of revenue off of our barrier islands from tourism, so that's a big part of our tax base as well, outside of the ad valorem piece. So they've got to weigh all those things out and decide, how much of an investment they can make and within a reasonable period of time, to get some sort of ROI on that. So I think you're going to see those decisions keep moving forward. We have several bridges that obviously need some love, so to speak, and but I can't answer that specifically if the bond markets are going to start to turn away. But when municipalities issue bonds, they're usually pretty well received. As long as they don't have too long a term on them, I think they'll be fine.
Okay, all right, let's go to this gentleman right here.
Thank you for this presentation. It's rather sobering. Looking at the general risk management scope, individuals aren't capable of mitigating the risk of sea level impact or its consequences. Some individuals are opting to accept the risk when they privately own and are not collecting insurance, which is fine. Avoiding the risk would be another one, people not living here and impacting overall tax bases. But given the fact that we have a skewed ability to transfer the risk, insurance, and the market seems constrained in order to be able to bring that up to a level that would drive some of these other factors, I'm curious, does PMI have any impact on the ability to loan a mortgage in an area that has a high likelihood, or at least a significant likelihood of flooding within the time frame of the mortgage? And are there any efforts to adjust taxation based on similar risks outside of just market valuation of homes in order to, because taxation is one way to generate revenue, but it's also a way to discourage certain behaviors. Is there any potential in the state of Florida for addressing that? Thank you.
On the issue of PMI, PMI is federally regulated as well. And for them to not want to lend in an area for fear of declining property values would be redlining, just like it would be for us as a lender. On a positive note, PMI has gotten very healthy over the last couple of years, the companies that insure mortgages, because we've made a lot more prudent lending decisions and probably made fewer mortgages than we could have otherwise. So the PMI companies are very solvent. And kind of a little known fact, people think that PMI is your enemy when you're getting a mortgage. Not true. Because we're sharing the risk with the PMI companies, you get a better interest rate on your mortgage if you do put less than 20% down and you do carry PMI, because you can drop that PMI. And then you're left with a lower interest rate mortgage than you would have gotten otherwise. So PMI, again, they cannot factor in the possibility of declining values unless the government determines an area to be a declining market, which we had, during the meltdown from 2008 going forward. We had declining markets, and it would affect the amount of exposure we would take in a declining market, but it didn't affect our lending in a declining market. And the last kind of holdout for declining markets here in Florida is condos. We're the last state in the country to still have a lot stricter condo financing rules than any other state. But little by little, that's loosening up too.
So they're healthy until the impact gets realized.
Right. I mean, what killed condos is people walked away from them because they lost their value during the meltdown, and associations stopped getting their monthly fees, and the associations became insolvent and, in some cases, bankrupt. We've seen a complete, 180 on that, and we're seeing condo associations much healthier now than they were 10 years ago. So, but Florida's still the toughest state in the country for condo financing.
The second piece of that, I'm trying to understand the question a little better. So, were you getting at trying to provide disincentives via taxation to prevent people from locating in those areas? That would certainly be outside of what I do, because obviously I do the value piece, and value times millage rates, which are set by taxing authorities, creates ad valorem taxes. So that would be some other form of a non-ad valorem assessment that would be imposed by taxing authorities. It could be like we talked about earlier. So some form of a non-ad valorem assessment within a neighborhood where you'd come in and everybody's going to have to, we're going to replace all the laterals. We're going to put some vaulting in. We're going to put flappers on the outfalls. We're going to do all these things. But if you want to live in this neighborhood, it's going to be attached. It's going to be a bond issue, like a community development district, and we're going to put 20 years of a bond debt on those lots that benefit from that infrastructure. So you could see that type of a thing happen, and that would be a disincentive for some people to buy in those areas. But other people that want to be on the water or in proximity to the water, they may go ahead and pay for that. So, but it would be a big disincentive, because usually a CDD that has bond debt on it like that, that's building out for a whole community. You've got all types of community amenities you're getting the benefit of. So it would be a disincentive for people to go there.
I wasn't talking about so much localized benefit, but
Okay.
given the fact that if that risk is
We
real,
can't,
it's gonna be spread, so.
okay, we didn't capture that, but
And,
Jake?
I think some of the disincentive is going to start with the flood risk 2.0 when you see those rates go higher. So now you've got somebody where $4,500 a year for non-waterfront home flood insurance is really going to start pinching them. My concern is somebody that bought the house 2 years ago. 2 years ago that same policy would have been about $1,800. Today it's already at $3,000. Now it pushes up to $4,500 or $5,000. They can't afford that flood insurance policy for homes in an area like Shore Acres, and nobody wants to come buy the house for and so if I were to say where's the kind of domino effect coming in flood insurance wise, that's really where I would push it, is that as rates continue to go up, you have people that are in a house that can't afford those rates, and you have people that don't want to buy the house because of the rates as well.
Okay.
And the likely progression of how that'll start to occur, sorry, Bob, you'll start to see areas where we're watching for increased listing activity, because the first step is homes just don't move, so they start to get dusty on the shelf, and that starts to occur. You see that rise of listing inventory, a dearth of sales, and then all of a sudden you start seeing price reductions. So we're watching for all of that to build that data model.
My apologies, gentlemen here, and Gene, can I ask the panel during our break if the gentleman would want to come up and ask a question? Is that okay? Okay, we're trying to stay on schedule here, so our time for this panel is come and gone. We're going to proceed to a break, but how about applause? Break time, and if you'd be back at your seats about 10:45, appreciate it. Hey, Libby.